Have you ever considered the typical path most individuals follow through their working lives, dedicating 4 decades only to reach retirement with barely enough to live comfortably? This often isn't due to a lack of options, but because the possibility of a different financial future simply isn't presented to them as attainable. Those who managed to achieve financial freedom sooner didn't stumble upon some obscure secret strategy or hidden knowledge. Instead, they simply paid attention to the financial calculations that most people tend to overlook or disregard in their daily lives. Let's look at Marcus and Derek, two men from Columbus, Ohio, whose journeys began under identical circumstances. They lived just 3 houses apart on the very same street, attended the same public school, and were part of the same graduating class of 2001. By the age of 24, both secured jobs that paid an annual salary of $52,000, setting them off on equal footing. Both started by renting apartments and had absolutely no savings to their names when they embarked on their careers. Fast forward to age 40. Marcus possessed a mere $11,000 in his savings, was burdened by car payments, and had only a vague intention of seriously planning for retirement soon. In stark contrast, by his 40th birthday, Derek had accumulated an impressive $847,000 in investments. This substantial sum wasn't tied up in volatile cryptocurrencies or some speculative startup venture pitched by a relative. His wealth was invested in steady, predictable index funds, the kind of straightforward investments even a grandparent could easily comprehend. Crucially, Derek never consistently out-earned Marcus throughout their careers. Their income levels were largely comparable. His highest annual salary, for example, reached $74,000, which wasn't drastically different from Marcus's earnings. This striking financial divergence at age 40, despite similar starting points and income, reveals a profound difference in approach. Their paths began in the very same neighborhood, growing up only 3 houses apart on the same street. They attended the same public school system and even graduated together in 2001, sharing a common background. By the age of 24, both secured entry-level positions, each bringing in an annual salary of $52,000. They both started out renting apartments and had absolutely no savings to their names when they embarked on their careers. Fast forward to age 40, Marcus possessed a mere $11,000 in a savings account, burdened by a car payment. He only had a vague intention of seriously planning for retirement sometime in the near future. In stark contrast, Derek had accumulated an impressive $847,000 by his 40th birthday, all thoughtfully invested. He hadn't received any inheritance, nor had he profited from selling a business. No lucky stock tip or sudden windfall contributed to his substantial financial growth. The vast financial difference between Marcus's $11,000 and Derek's $847,000 wasn't due to talent, income, or mere chance. Instead, it stemmed from a single, critical choice Derek made at 26, a decision Marcus consistently postponed. This singular action, coupled with the powerful effect of compounding over 14 years, created the immense disparity. Many people, upon hearing early retirement, immediately envision tech CEOs or individuals with trust funds. They assume these people started with unfair advantages, causing them to disengage before understanding how it could apply to them. True early retirement, whether in your 50s or even late 40s, isn't about a specific personality or a high salary. It's fundamentally a math problem with solvable answers. The solution to this mathematical challenge is remarkably straightforward, almost to an astonishing degree. Financial professionals, however, are unlikely to guide you through this specific calculation. This is because its outcome significantly reduces your reliance on their services. Derek, on the other hand, uncovered this secret one Saturday afternoon, armed only with a spreadsheet. Meanwhile, Marcus continues to defer, perpetually waiting for an opportune moment that never arrives. Soon, we will meticulously detail Derek's entire journey, showing his actions year by year. Every financial move, every dollar, will be laid bare for you to understand. Crucially, you'll discover why this opportunity remains available to you right now. This holds true even if you feel you're beginning your journey later than ideal. If your age falls within the range of 32 to 52, this particular segment is tailored precisely for your situation. Most likely, you're experiencing one of two distinct emotional states regarding retirement planning. Perhaps you haven't even begun, and a quiet sense of guilt surfaces whenever retirement is discussed. This unspoken unease persists, a subtle reminder of your inaction. Alternatively, you might have initiated some planning, but without true commitment or seriousness. Maybe you have a 401k, but you're only partially contributing to it, not maximizing its potential. While some, like Marcus, remain hesitant, waiting for the opportune moment, others, like Derek, have already taken action. Derek, for instance, mapped out his path to financial freedom on a Saturday afternoon, simply using a spreadsheet. Soon, we will reveal Derek's precise journey, detailing his progress year by year, dollar by dollar. Such a demonstration will reveal why the opportunity remains open for you, even if you feel you're beginning later than ideal. Specifically, if you find yourself between the ages of 32 and 52, this particular segment is crafted with your situation in mind. Beneath these different approaches, a common and powerful anxiety often lurks, the belief that it's simply too late. Such a pervasive thought suggests that early retirement is exclusively for those who started meticulously planning at 22. It implies it's not for individuals in their 40s, looking back and wondering where all the years have gone. This very apprehension, however, serves a significant purpose for the traditional financial industry. The instant you accept that it's too late, you cease to analyze your options or calculate possibilities. You effectively surrender control to those who have been anticipating your resignation from the challenge. Yet, the underlying mathematics presents a very different conclusion, challenging this widely held belief. The numbers reveal a different truth. A 38-year-old making $68,000, saving 25%, could be financially independent in 17 years. Achieving that goal means reaching it by age 55, not the typical 65, specifically 55, without any special advantages. This outcome is achievable even with average market returns, no inheritance, no extra income, and no particular luck. Many wrongly assume that early retirement is only for those who began planning young, perhaps in their early 20s. They believe it's too late if you're approaching your 40s and feel that precious time has simply slipped away. This very fear that you're past your prime for financial planning greatly serves the interests of the financial industry. The instant you internalize this too late mindset, you cease to analyze your options or make any calculations. However, the reality is that your remaining timeline is still a significant advantage for pursuing your goals. The only real difference when you start later in life is the increased sense of urgency it creates. Paradoxically, this very urgency often proves to be the exact catalyst many individuals needed all along to take action. Now, let's reveal a critical insight that the financial sector has intentionally kept from you for decades. This crucial truth is that your personal savings rate significantly outweighs the importance of your actual income. We're not talking about a minor difference. Its impact on your financial journey is dramatically more substantial. Consider someone earning $120,000 annually, yet only managing to save a mere 5% of their income. This individual will achieve financial independence much later than a person earning $65,000. That's because the lower earner consistently saves a much higher 30% of their earnings. This isn't just a motivational thought. It's a fundamental principle of arithmetic, undeniable and precise. The inconvenient truth this implies is that most people don't need more money to retire early. They need a different relationship with the money they already possess. The financial industry has deliberately spent decades obscuring a fundamental truth from the public. They've actively worked to ensure this crucial insight remains unclear to most individuals. The industry thrives by maintaining this lack of clarity regarding personal finance strategies. For example, An investor who grasps that low-cost index funds combined with a high savings rate provides 90% of the solution. Such an informed individual has very little need for extensive financial management services. Naturally, this straightforward and empowering truth is never promoted through advertising campaigns. The majority of people, therefore, never uncover the most impactful factor in their journey to retirement. It's not about the size of their salary or their skill in selecting individual stocks. Instead, the true power lies in the exact percentage of their income they manage to retain and invest. Even a modest adjustment to this savings percentage, say by just 5 points, yields significant results. It doesn't merely increase your savings. It can dramatically shorten your entire working career by years. At the core of early retirement calculations lies a critical principle known as the 4% rule. This rule states that if your investment portfolio is substantial enough for 4% of its value to cover your yearly expenses, you can then withdraw that specific amount annually, potentially forever, without depleting your capital. Thus, the real question isn't a vague, "How much do I need?" but rather a precise inquiry into your exact annual expenditures. Many individuals overlook the most significant factor influencing their retirement schedule, which isn't their earnings or investment choices. Instead, it's the proportion of their earnings they manage to save and retain that holds the true power. Adjusting this percentage, even slightly by 5%, doesn't just boost your savings. It can dramatically reduce the number of years you'll need to work before achieving financial independence. Therefore, the inquiry isn't about a general, undefined sum you might require for retirement. The calculation is precise. Simply multiply your total annual expenses by 25. For instance, if your annual spending totals $48,000, your target for financial independence, or FIRE number, becomes $1.2 million. This specific figure, $1.2 million, stands as the precise objective, not a much larger sum like $3 million. Let's now examine the profound effect a consistent savings rate has on your overall timeline to retirement. Consider an individual with an annual income of $65,000, bringing home $51,000 after taxes. With a 10% savings rate, setting aside $5,100 annually, they would accumulate $1.2 million in 46 years, retiring at age 70. Increasing their savings to 20%, or $10,200 each year, shortens this journey to 32 years, allowing retirement at 56. A 30% savings rate, amounting to $15,300 annually, enables them to hit the target in 25 years, retiring at 49. By saving 40%, which is $20,400 per year, they could achieve their goal in just 20 years, retiring as early as 44. Notice that their income remained constant, and there were no unusual market conditions at play. Only one factor shifted, yet it shaved an incredible 26 years from their working timeline. The 7% annual return used in these calculations was intentionally set at a conservative level. Historically, the S&P 500 index has delivered an average return of approximately 10% each year over the last century. Should a 10% return be achieved, those projected timelines for reaching financial independence would shrink even further. Consider another powerful illustration of compounding: the impact of redirecting a small amount of money. Every $100 per month diverted from spending into investments could accumulate to roughly $120,000 over 2.5 decades, assuming a 7% return. The mathematical implications of these consistent, modest financial adjustments are remarkably potent when observed over an extended period. Now, let's shift our focus back to the parallel lives of Marcus and Derek. Both were 24 years old, residing in Columbus, and each earned $52,000 annually, bringing home approximately $40,000 after taxes. They shared similar apartments, drove identical used vehicles, and started with no initial financial advantages. 2 years later, at the age of 26, Derek's path began to diverge. One Tuesday evening, he stumbled upon an article detailing the financial independence, retire early, or FIRE movement. That subsequent Saturday, he dedicated his time to meticulously crunching the numbers for his own situation. His calculations revealed an annual expenditure of roughly $28,000. Based on this, he determined his personal FIRE number, the amount needed for independence, was $700,000. Armed with this target, he proceeded to open an investment account. Having opened his investment account, Derek promptly set up automatic monthly contributions. He committed $1,100 each month, channeling 28% of his net income into savings. These funds were directed into a broad market index fund, and he largely adopted a hands-off approach. This strategy capitalized on the powerful principle that small, consistent financial redirects yield substantial long-term growth. Indeed, diverting just $100 monthly could accumulate to approximately $120,000 over 25 years. Let's now turn our attention to Marcus and Derek when they were both 24, living in Columbus. Each earned an annual salary of $52,000, taking home roughly $40,000 after taxes. Their living situations were identical, residing in similar apartments and driving comparable used cars. Neither individual had any initial financial advantage or family support to kickstart their wealth. By age 26, Marcus received a $3,000 salary increase, which he immediately used to upgrade to a larger apartment. He also opened a 401k plan, primarily because his human resources department had advised him to do so. Marcus contributed a modest 3% of his salary, just enough to secure his employer's matching contribution. He genuinely believed this minimal effort constituted his complete investment strategy at the time. For years later, at age 30, Derek's salary had risen to $58,000. He consistently channeled all his raises into investments, deliberately maintaining his previous, modest lifestyle. At age 30, Derek's consistent strategy had already grown his investment portfolio to an impressive $87,000. His contributions were set up automatically, flowing seamlessly into his accounts almost without him noticing the process. Around the same time, Marcus was earning $61,000 annually, choosing to significantly upgrade his lifestyle. He moved into a larger apartment and purchased a new car financed by a 60-month loan. His financial reserves remained limited, with only $4,200 in his 401k and a modest $1,800 in savings. Marcus often told himself he would commit to serious investing once his car loan was fully paid off. By age 35, Derek's salary had increased to $67,000, allowing him to contribute $1,400 to his investments each month. His diligent efforts had propelled his portfolio to a substantial $231,000. Remarkably, his accumulated wealth was now generating over $16,000 annually purely through its own growth. Meanwhile, Marcus's income reached $64,000, and his car loan was finally repaid. However, the $380 he once spent on car payments simply dissolved into his daily expenses without a trace. With $19,000 in his 401k, Marcus began to read about investing, suddenly feeling significantly behind, a feeling that was entirely accurate. At age 40, Derek's investment portfolio had surged to an astonishing $847,000. Out of this sum, approximately $629,000 represented pure compound growth, money that his money had made for him. Marcus, at the same age, had only $52,000 across his savings and 401k, facing a daunting path to catch up. Over 14 years, Derek had personally contributed around $218,000 to his portfolio, showcasing the power of consistent input. He was now just 3 years away from achieving financial independence, able to choose whether to work or not. For Marcus to hit $1.1 million, he needed to invest $2,200 monthly for 20 years at a 7% return. This staggering sum represented 52% of his take-home pay, an amount practically impossible for him to sustain. The significant gap between their financial situations wasn't due to income disparities, as many might assume. Derek's highest salary was $74,000, only marginally more than Marcus's $68,000 annually. Instead, it stemmed from a single, automated financial decision made 14 years prior by Derek. This choice was made long before either man could foresee the trajectory their lives would take. Such is the stark reality revealed by this financial arithmetic, encapsulating the entire narrative. This brings us to the first fundamental rule for financial independence. Calculate your precise FIRE number. Ambiguity is the adversary of decisive action, so defining your target clearly is paramount. To determine this, simply multiply your annual spending by 25 and diligently record the figure. For instance, if your yearly expenses total $52,000, your personal FIRE number would be $1.3 million. Having a clear financial target transforms the abstract idea of retirement into a manageable countdown. The second essential principle involves optimizing your savings rate above all else, rather than solely focusing on income increases. A significant increase in your savings rate, for instance, from 10% to 25% on a $60,000 salary, will advance your retirement timeline more than a $20,000 raise spent conventionally. Before your next pay negotiation, calculate the exact impact a mere 5% boost in your savings rate would have on your FIRE date. This insight will undoubtedly reshape your priorities. The third crucial guideline is to proactively redirect every pay raise you receive, ensuring you allocate it before you even have a chance to adjust your spending habits. Lifestyle creep is not a personal failing. It's simply the natural outcome when additional money arrives without a clear, predefined purpose. Therefore, with every salary increase, commit to channeling at least 50% of the after-tax amount directly into your investments before it ever touches your everyday budget. For instance, half of a $4,000 raise immediately adds an extra $166 to your monthly investment contributions. Projected over 15 years, with a conservative 7% annual return, this consistent redirection could accumulate to approximately $50,000. The beauty of this approach is that you won't miss funds you never mentally integrated into your regular spending plan. Our fourth fundamental principle urges you to cease postponing your financial journey until you believe you'll earn a higher income. Consider a 30-year-old who invests a steady $400 monthly until age 60, potentially accumulating an impressive $490,000 at a 7% annual return. Now, envision a 40-year-old who starts investing the identical $400 each month, also aiming to retire at 60. This individual will achieve a considerably lower total, simply due to the lost decade of powerful compounding. This stark contrast powerfully illustrates the profound advantage of beginning your investment journey as early as possible. The most important action is to start investing today, no matter the amount, rather than waiting for a perceived, perfect financial moment. Embracing these actionable rules empowers you to gain mastery over your financial future and significantly accelerate your path toward true independence. This comprehensive understanding will fundamentally reshape your financial priorities and approach. Our third crucial guideline is to proactively reallocate a portion of every pay raise before you even get used to the additional income. Lifestyle inflation isn't a moral failing. It's simply what occurs when new money appears without a clear directive for its use. With each salary increase, commit to redirecting at least half of that after-tax amount before it ever becomes part of your regular spending. For example, a $4,000 raise, with 50% redirected, instantly add an extra $166 every month to your investment portfolio. Projected over 15 years, assuming a 7% annual return, this seemingly small adjustment could accumulate to approximately $50,000. The brilliant aspect of this strategy is that you won't miss money you never accounted for in your daily budget to begin with. Our fourth essential principle is to begin investing immediately, rather than postponing until you believe your income will be higher. A 30-year-old contributing $400 monthly until age 60 could amass $490,000 at 7%, whereas a 40-year-old doing the same only reaches $208,000. despite identical contributions and returns. A mere 10-year delay in starting investments results in a staggering $282,000 loss in potential wealth. Commencing with $200 today significantly outperforms waiting 5 years to invest a larger $500. The mathematical evidence is unequivocally clear. Rule number 5 advises making index funds your primary investment choice, viewing unnecessary complexity as a financial adversary. Consider Vanguard's VDSAX, which charges an annual fee of just 0.04%, a stark contrast to the 0.7% typically levied by actively managed funds. On a $500,000 portfolio, these seemingly minor fee differences translate to $3,300 in avoidable yearly costs, leading to over $100,000 lost to compounding over 2 decades. The boring approach consistently proves superior. Finally, Rule 6 suggests familiarizing yourself with a Roth conversion ladder well before retirement, as the perceived 10% early withdrawal penalty on 401k funds isn't always unavoidable. Instead, you can transfer traditional 401k assets into a Roth IRA each year after leaving your job. This strategy involves paying income tax on the converted amount, but crucially, it avoids any early withdrawal penalties. Following this conversion, a 5-year waiting period is applied to these funds. After this seasoning period, the money becomes fully accessible without incurring any penalties whatsoever. Imagine retiring at 50. By age 55, you could tap into your retirement savings entirely free of penalties. The Internal Revenue Service itself incorporated this provision, creating a viable pathway within the tax code. Yet, the majority of individuals reach age 65 without ever discovering this valuable option. Moving on to rule number 7. Consider implementing a part-time bridge strategy for your transition into retirement. Becoming retired doesn't necessarily mean you must cease all work activity forever. For instance, someone with $600,000 invested at age 48 who earns $20,000 annually part-time offers a prime example. This individual would only require their investment portfolio to cover $28,000 of their total $48,000 in yearly expenses. Consequently, their portfolio's effective withdrawal rate plummets to a mere 1.3%. This low withdrawal rate allows their invested capital to continue growing steadily. They could choose to work just 2 days a week, engaging in an activity they genuinely enjoy. This scenario truly represents financial freedom, attainable well before reaching conventional full retirement age. It's noteworthy that someone who chooses to retire at 50 can access their retirement funds 5 years later, at 55, without incurring any penalties. This specific provision was deliberately incorporated into the tax code by the IRS itself, acting as an intentional door for early access. Yet, a majority of people typically wait until 65 to retire, completely unaware that this advantageous option even existed. This brings us to a crucial principle, often referred to as Rule 7, strategically utilizing a part-time bridge. The concept of being retired doesn't necessarily mean you must never engage in any form of work again. Now, let's vividly imagine 2 distinct versions of yourself when you reach the age of 58. In the first scenario, you're seated opposite an HR manager, compelled to delay your retirement until 67 because your financial calculations still don't add up. The chronic pain in your knee, once something you could ignore, has now become increasingly insistent and difficult to dismiss. You are competent at your profession. You've always performed well and consistently excelled in your role. However, the thought of enduring the identical commute, the same endless meetings for another 9 years feels suffocating. This grim realization settles deeply within your chest, a heavy and unwelcome presence that stubbornly remains. Consider the alternative. The second version of you is 3 years into a lifestyle you've stopped calling retirement because the term no longer fits. You occasionally take on consulting projects purely because you genuinely enjoy the work and the intellectual engagement it offers. Last spring, for instance, You indulged in a wonderful 6-week journey exploring the vibrant landscapes of Portugal. You are now fully present for all the significant moments you once routinely missed, and your investment portfolio continues to grow beyond its initial value. The current financial projections still refuse to align, leaving a persistent gap in your long-term plans. Moreover, the physical discomfort you've long overlooked has now become increasingly difficult to disregard. You maintain a high level of competence in your work, a quality you've consistently demonstrated throughout your career. Yet the thought of enduring the identical commute and the same meetings for nearly another decade is truly daunting. This unsettling prospect lingers, a heavy weight in your mind that simply won't dissipate. Despite your current financial independence, you aren't considered conventionally rich by typical media definitions. Instead, you've achieved genuine freedom, measured by the values and priorities that truly resonate with your soul. Both versions of yourself, the one bound and the one liberated, began with identical information and opportunities. The crucial distinction between their outcomes wasn't rooted in inherent talent, income level, or sheer luck. The sole differentiator was whether they took the initiative to analyze and understand their financial possibilities. These calculations are not inherently complex, nor is the underlying financial knowledge restricted to a select few. The opportunity to choose a different path remains open and available to you right now. The ultimate query then becomes, how will you choose to utilize the present moment, this very Saturday afternoon? Take this opportunity to reflect on your future, to chart a course towards the profound freedom you envision. If this story resonated, consider subscribing to explore more insights that empower your journey to true independence.